Welcome to Mortgage Map. For decades, the 30-year fixed mortgage has been the standard choice for home buyers seeking stability. However, when interest rates rise, the high monthly payments on a fixed loan can push homeownership out of reach for many buyers. In these markets, you will often see lenders promoting adjustable rate mortgages, or ARMs, as a way to secure a lower initial interest rate and monthly payment. While ARMs are often feared by buyers who remember the housing crash of 2008, modern ARMs are highly regulated financial products that can be beneficial if you understand how they work. An ARM is not a gamble if you understand the rules, the adjustment index, and the interest rate caps. Today, we will explain the mechanics of adjustable rate mortgages, breaking down the hybrid structure, the rate cap rules, the adjustment index, and how you can calculate the worst-case scenario using real numbers. Let us first examine how an adjustable rate mortgage is structured and the meaning of the numbers used to describe them. Modern ARMs are hybrid loans, meaning they combine a fixed rate period with an adjustable rate period. Lenders display these programs using two numbers, such as a 5-1 ARM, a 7-6 ARM, or a 10-6 ARM. The first number represents the initial period during which your interest rate is locked and cannot change. For example, a 7-6 ARM has a fixed interest rate for the first 7 years. The second number represents how often the interest rate can adjust after the fixed period ends. Under modern guidelines, most ARMs adjust once every 6 months, which is indicated by the number 6. During the fixed period, your monthly payment is calculated exactly like a standard fixed mortgage. However, once the fixed period ends, your rate will adjust based on a market index. The standard index used today is the Secured Overnight Financing Rate, or SOFR, which reflects the cost of borrowing cash overnight. To determine your new rate, the lender takes the current SOFR index value and adds a set percentage called the margin, which is typically fixed at 2.75% for the life of the loan. It is also important to remember that because the initial fixed period is shorter, lenders can offer a lower starting rate. This starting rate, often called the teaser rate, can be 1 to 2 percentage points lower than a standard 30-year fixed interest rate. This lower rate results in immediate monthly savings that you can use to pay off other debts, invest in home upgrades, or build up your household savings reserve. It is also crucial to note that modern hybrid ARMs amortize over a full 30-year period. This means that your monthly payments are calculated using a 30-year schedule, which keeps your mandatory payment low during the initial fixed period. Many borrowers confuse hybrid ARMs with balloon mortgages, but ARMs do not require you to pay off the entire loan balance at the end of the fixed period. Instead, the loan simply continues with an adjusting interest rate. Second, let us analyze the interest rate caps that protect borrowers from extreme payment increases. To prevent your mortgage payment from skyrocketing overnight, all ARMs feature a cap structure that limits how much the interest rate can increase. These caps are represented by 3 numbers, such as 225 or 525. The first number is the initial cap, which limits how much the rate can increase the very first time it adjusts. For example, with a 5% initial rate and a 2% initial cap, your rate cannot exceed 7% at the first adjustment. The second number is the periodic cap, which limits how much the rate can increase or decrease during any single adjustment period thereafter, typically capped at 1 or 2%. The third number is the lifetime cap, which sets the absolute maximum interest rate you can ever pay during the 30-year loan term. If your initial rate is 5% and your lifetime cap is 5%, your interest rate can never exceed 10%, regardless of how high market interest rates climb. Understanding these caps allows you to calculate your maximum possible monthly payment, ensuring you are prepared for the absolute worst-case scenario. Lenders are legally required to verify that you qualify for the ARM loan based on a higher interest rate than the initial teaser rate. Usually, underwriters evaluate your debt-to-income ratio using either the maximum possible interest rate at the first adjustment or the initial rate plus 2%. This regulation ensures that you have the financial capacity to afford the mortgage even if the rate adjusts upward immediately after the fixed period expires. For example, let us assume your initial rate is 5%, and your cap structure is 525. The first 5 represents the initial cap, meaning the rate cannot rise above 10% at the first adjustment. The 2 represents the periodic cap, limiting any subsequent adjustments to 2%. The final 5 is the lifetime cap, confirming your rate can never go above 10%. If SOFR rises dramatically, your caps will protect you from sudden shocks. Finally, let us discuss who ARMs actually fit, the potential risks, and the steps to evaluate if an ARM is right for your purchase. ARMs are a great fit for buyers who have a clear timeline and plan to sell the home or refinance the mortgage before the initial fixed-rate period ends. For example, if you are purchasing a starter home and plan to move within 5 years, securing a 7-year ARM allows you to enjoy a lower interest rate and save thousands of dollars during your entire period of ownership. However, if your plans change and you remain in the home, you face the risk of rate increases. To evaluate an ARM, follow 3 simple steps. First, calculate the monthly savings during the initial fixed period compared to a standard 30-year fixed mortgage. Second, calculate your maximum monthly payment under the lifetime rate cap. Third, verify if your household budget can comfortably support that maximum payment if you are unable to sell or refinance. By taking these logical steps, you can utilize an ARM to lower your housing costs without exposing your family to unnecessary risk. Additionally, ARMs can be a strategic choice for high-income earners who expect their earnings to grow significantly over the next few years, allowing them to pay down their principal loan balance rapidly during the fixed-rate phase. Understanding the index, the margin, and the lifetime caps of your specific loan program will give you the confidence to manage your mortgage dynamically as financial market conditions fluctuate over time. Mortgage Map is a calm guide for first-time buyers and curious homeowners navigating the home buying process. The channel explains down payments, interest rates, closing costs, pre-approvals, refinances, loan types, and common mistakes with real numbers and simple visual examples in plain English without financial advice or market hype. This video is general mortgage education, not financial, investment, legal, or tax advice. We are not a lender and do not recommend specific loan products. Mortgage programs, rates, and terms change frequently. Consult a licensed mortgage professional before making financial decisions.